But I think that went well. Let's see the next principle.
Okay, so the next principle is that it's to indemnify. And this is where the insurance company will put the insured in the same financial position as before the event took place. So the whole idea here is that the insured will be covered for the loss or the risk or the damage.
Yeah. Great. Now we just got a message here from one of the students who asking us to keep the slides a little bit longer because they would want to write down the information.
Correct. Okay, so we were speaking about indemnify, and this is again the case of if I had a Samsung phone, a specific Samsung phone, something happens to it, I dropped it by accident and my insurance put in a claim at my insurance, they will replace it with exactly the same Samsung phone.
Okay, so here you can see an example. This was the original one.
Yes.
You got for a present, Mother's Day. This looks like the Samsung S1 Mini. Mm-hmm. And then the next day it was dropped, stolen. And now you try and put in a claim for a Galaxy S7 Edge.
Yeah.
Is it going to happen?
Nope.
No, it's not going to happen.
There we go.
If they indemnify you, they will put you in the same position.
Yes.
And you get the same one. There's one learner indicating that, can I get a copy of the info on the slides through WhatsApp? We will have to explore that, but we'll keep that in mind. I'm being taught quite a few things today.
Okay.
Now, insurable interest. Insurable interest. What is that?
Lisa, I'm leaving this one up to you.
Okay, what does it say? A person can only insure an asset and claim if they are going to suffer a financial loss when an event occurs. Insurable interest simply means that you can insure an asset and claim if you are going to suffer a loss when it occurs. Now, if you look at examples of insurable interest, an individual can insure his or her own life. Okay, so what's going to happen? I've got a family, so I can insure my life. So if I die, hopefully it's not going to happen soon, but if I die, my dependents will then get a lump sum payout.
That's correct.
Okay, so an individual, any person, provided you've got the money to pay your premium, you can insure your own life. So that's a general rule.
Yeah.
An individual or a business may insure not only his life, but also his assets.
Yeah.
So if you've got a house, a car, a cell phone, you can insure not only your life, but also your assets. It must belong to you. I think that's important.
Yes.
A married woman can insure the life of her husband.
And also vice versa. The husband or a husband can insure the life of his wife.
Okay, so that's also true. Okay, thank you. A business partner
Can do the same.
can insure the life of the other business partner. Now that makes sense because if he dies, then you sit with all the liabilities. Yes. So please, if you're in partnership with anybody, make sure that their lives are insured.
That is correct.
And then finally, a creditor, remember a creditor is a person to whom money is owed, can insure the life of the debtor, the person owing him the money. If he doesn't do that, and that debtor dies, his money also dies with the debtor. So it's important that if you do lend people money, make sure that you insure their lives also. And that we call an insurable interest. You've got an insurable interest in those people's lives. Okay, the next one, Mel, is utmost good faith. Not just good faith, but utmost. What does that mean?
It's basically a trust relationship between the insurer and the insured, and it expects of the insured to be absolutely honest when taking out this particular contract. So, for example, learners, if Lester decides his favorite sport is rock climbing,
Heaven forbids.
when he does take out this particular insurance, he is then under obligation to disclose to the insurer that he participates in dangerous sports.
Yeah, good.
And that would be the same for anybody who's very adventurous.
Yeah.
But in that way, there's a trust relationship between the insured and the insurer, and that there is full disclosure.
And also, if you've got a pre-existing medical condition,
Yes.
that you do acknowledge that and make it known.
So you would do it for those kinds of situations. It's mostly done when you get to sporting activities that are fairly dangerous, medical conditions, and possibly even if you have a car that you've had for a very long time and has accumulated quite a substantial mileage in excess of maybe 650,000 kilometers. So once you start, negotiating that insurance contract, you would then disclose that.
But now that utmost good faith is also on the part of the insurer.
True.
So
True.
if you pay your premiums regularly, there's that good faith or utmost good faith that in the event of a legitimate claim, that they will pay you out and not just claim they are bankrupt.
True.
So
True.
that is utmost good faith. Again, we are getting WhatsApp messages fast and furious, and there are some learners sending in their email addresses and asking me to please send it to those addresses. Learners, I cannot unfortunately do that. You've got to send me an email to my email address, and I will take it from there. Melanie, the next topic that we need to cover, the difference between an insurable risk and an uninsurable risk. Can you just take us through that quickly?
Okay. So for an insurable risk, the insured must derive a financial benefit from the existence of the object which is insured. Secondly, the insured stands to lose financially if goods are destroyed by the death of a person.
Good. And an uninsurable risk?
That happens when there is a risk for which no insurance can be written, or if the chance of loss is very high or cannot be accurately measured, then you'll have an uninsurable risk.
Yeah, I think it will be more clarified if we look at examples.
Yes,
Let's just
no,
give them
I
two
agree.
examples quickly
Yes.
of an insurable risk.
Okay, so the examples of insurable risks are when you deal with a multi-peril policy, and this is when you have a specific policy that covers more than one aspect. For example, if you have insurance on your house and you also then cover the contents of the house. So the first aspect of it may be for the structure and storm damage, which is usually the case.
Yeah.
And then the second aspect would be for the contents of the house.
Okay, but you can also have the contents of your house and your car.
True. It could be any, it
Any
depends on the way in which the actual contract is written.
Okay, good. And that we call a multi-peril
Peril policy.
Okay, so that would be insurable risk.
That would be an insurable risk.
What else?
When you are insured for fire, that would also be an insurable risk.
So that's if the fire destroys the asset.
The actual asset, yes.
Yeah.
Then the assets policies would also become an insurable risk. That's when you're insuring your car, your phone, your buildings, your laptop, and also your personal properties policy. I think laptop is more prone to falling under personal property policy.
And also your household content.
Yes, your household contents.
Your household content.
Then your uninsurable risks, examples of that would be a pre-existing condition, so something that you would have had to disclose, and then something that cannot be controlled, like damage incurred when earthquakes happen or nuclear wars happen.
Okay, thank you for that. Melanie, I see that Malibu High School is also tuned in, and Modderdam High School is also tuned in. There might be one or two teachers that you know there, eh? Then is the next one. Mel, the difference between short-term insurance and long-term insurance.
Okay, so when we're speaking about short-term insurance, we speak about a cover in regards to a person's belongings, and thus the insurance usually covers personal property. So we're speaking here about household contents, maybe a car, laptops, cell phones. Can you think of any? Jewelry,
Jewelry, yep.
very expensive jewelry.
Absolutely.
And so you're usually wanting to be insured against theft or burglaries or particular damage.
Yeah.
Then long-term insurance, we're speaking specifically about the link to a person's life or well-being. And this type of insurance is usually paid over a longer period of time as opposed to the insurance that you would pay for cars and jewelry and laptops, etc.
I think that's where the name comes from, long term. You
long
pay it over a longer period of time.
And the period of time is dependent, the long-term period of time for long-term insurance is dependent on what the specific insurance is. So if it's life insurance, it would be on the life of that person
Until you die.
until you die.
Even though there's been quite variations now in terms of life insurance. I know there's one, I'm not going to mention the name of the insurance company, but they actually pay for 60 months a large premium.
Yes.
And then it's done. You don't pay anymore. So there's been quite a change in the way they deal with it.
I think it's the way in which insurance companies write these insurances. I know that there are insurance companies for life insurance where they write it, where they attach a no-claim bonus to it as well.
Yes.
And I think it's just to give people incentives